Welcome, Stephen, to Wealth Matters podcast. How are you today?
Hey, Alpesh, I'm doing great. Thanks for having me today. How are you doing?
Good, good. Hey, I appreciate you taking time out of your busy schedule.
Of course, man.
Hey, so can you tell us what you do?
Yeah, so me and my business partner, we have a wealth advisory firm here in the San Francisco Bay Area. Our office is located in San Ramon, California, and we help clients with really kind of a main focus on four things. We do cash flow management, investment positioning, tax planning, and estate preservation. Some of our biggest focus is really around advanced tax planning for wealthy individuals, along with small to medium-sized business owners.
Interesting. And I think we do want to talk about that particular aspect of your advisory services, right? How do you look into tax planning or tax saving investments?
So there's quite a few different strategies that are out there depending on the client situation and what they're trying to accomplish. There's a new exciting strategy that came out at the end of 2017 called the Opportunity Zones, which is a phenomenal tax advantage for investors who have any capital gains issues. And then, we also get into charitable LLCs and different things like that as well, just depending on what the client's needs are and what they're trying to accomplish. And if they need their cash liquid now, or if they don't mind leaving it unliquid for a longer period of time, then we'll choose different strategies based upon those requirements.
Interesting. I just heard you mention about Opportunity Zone. Can you explain what it is?
Yeah, so the Opportunity Zone, to me, it's very exciting. It's a new strategy that came out in the Tax Cuts and Jobs Act of 2017. What Opportunity Zones are, though, specifically? They are low income, basically census tracts that have been nominated by the different governors in 50 states.
Oh, really?
Yes, and it's also certified by the U.S. Department of Treasury. So that's also nice that it's approved on the state level and the federal level. And basically, what it's for, it's really to encourage investors to reinvest capital gains into these areas. So these census tracts are lower income type areas that really haven't seen the big economic boom that a lot of the other parts of the country have seen over the last
Right.
years. And this is a way for basically the government to incentivize these investors to be able to invest into these lower income census tracts. And what's crazy is one of the big reasons why they're doing this is because they estimate that taxpayers currently hold over $6 trillion. That's with a T, unrealized
Wow.
gains. So the government sees this as a huge resource for economic development in these opportunity zones.
Yeah, makes sense.
Yeah, it's pretty amazing some of the stuff that they put together for this.
So, if I understand correctly, government wants investors or wealthy individuals or whomsoever to invest in this, low-income neighborhood, so that this, low-income neighborhood also grows and props up, property value, and of course, attracts, better-paying jobs or whatnot, right? As
Correct.
well as a
Correct.
kind of a gentrification, right?
Correct. Yeah, the government has done this in the past with tax credits and different things like that to invest in certain areas. But this specific opportunity zone has really, I feel, streamlined and made the process much easier for investors. And the government's trying to have these investors move all that money that's sitting in these different capital gains, either it's stocks or real estate or whatever it might be, and move it so it can move into these other lower income areas and really help those areas prosper better.
Interesting. So where are these opportunity zones located? You did mention it's in 50 states, but is it just one area in each state, or maybe in a small neighborhood, or you have a lot of opportunities?
So there's quite a bit of opportunities in each state. So each governor was given the chance to go out and designate certain opportunity zones in their state. So all 50 states have them. There is opportunity zone maps out there that people can go and look and see what is an opportunity zone in their specific state. But not only that, it's also opportunity zones are located in U.S. territories. So what's interesting is most of Puerto Rico is actually an opportunity zone, which is pretty
Wow.
cool.
Wow, that's cool. It's a tax heaven.
Yeah. It is, yeah. No, it is, and it's it's paradise down there. It's a beautiful
Yeah,
place, and people can invest money down there and receive some
exactly.
incredible tax benefits.
Wow. So, can you spell out the benefits of opportunity zones in detail?
Yeah, for sure. So there's four main benefits for investors to invest in opportunity zones. I'll just kind of run through the four of them real quick and give a brief description.
Sure.
The first one is deferral of capital gains. Well, what does this mean? So any type of capital gains, you can invest into opportunity zones and get a deferral on paying those capital gains. So this can be short-term or long-term capital gains. It can be from stock. It can be from selling a real estate property. It can be from selling a business or
This
any
is
other asset.
this is
Yes.
exciting.
Yeah.
Just
No.
so I don't have to go from real estate to real estate. I can actually go from stocks. Like I'm pretty sure, in Bay Area, a lot of people have tons of stock gain, and I can invest my stock gain into opportunity zone real estate. Wow.
Yeah, absolutely. And the great thing about it is if you invest whatever gains you invest into this opportunity zone, you don't have to pay taxes on those original gains until December 31st of 2026.
Oh my God. So I can leverage all that money, yeah, and invest in something, and I don't have to pay taxes for almost 8 years.
Absolutely. Yeah, no, that's what's awesome about it is that you're basically using, in a way, the federal tax dollars that would have went to the federal government. You can actually use that in your favor as a compounding over the next 8 years to build wealth more.
Go for it. I'll be interested myself. We
Yeah,
can
I
go
mean,
to the
that's just one of the four. The next one is the reduction of capital gains. This one's really great as well. So what that means is that if you invest in any opportunity zone and you hold that investment for at least 5 years, you'll get a 10% step up in basis. And
Hmm.
then if you hold it for an additional 2 years, so a total of 7 years, they'll give you a step up of 15% in basis.
Yes. So 5 more%, right? If you have
Yes,
more, 2 more years.
exactly,
Got it.
exactly. 5 more%. So basically what that means for any investor out there, let's just say, example wise, if you bought $500,000 worth of Amazon stock 10 years ago, and now it's worth 1.5 million, and you decide to sell that stock, well, you can that $1 million you put into the opportunity zone. If you hold it there for at least 7 years, you only have to pay tax on 850,000.
Wow.
So that's a pretty awesome incentive
That
that's
is
included with the opportunity zone. And then there's also two more. This next one I think is the best one and the most exciting for me. It's the elimination of capital gains taxes for investments in opportunity zones. So what does that mean? So any gains made inside of the opportunity zone investment, as long as it's held for 10 years, if it's held for at least 10 years, it's all federal tax free.
so you are saying that I won't have to pay any tax, nada, zero?
You want to pay any federal tax.
Okay.
States will if the states participate in the Federal Opportunity Zone Act, then you can also eliminate the state tax as well. But definitely on the federal side,
Wow.
you do not have to pay any federal tax on the capital gains from the investment made in the opportunity zone if you held it for at least 10 years.
That's huge.
It's,
No
I mean,
federal that's so amazing.
yeah. No, it's pretty amazing. I mean, even if you didn't have a capital gains issue and
Right.
you just wanted to put money into an opportunity zone, you still get that benefit. So it just anything invested, as long as you hold it for 10 years, you won't have to pay any federal capital or any federal tax on that.
That's amazing. I'm definitely even more interested.
Yeah, and then it is, and then I'll pass on the last one is the last benefit is the possible state income tax benefits, and I kind of alerted to this just a second ago. This will depend on the state where the stockholder is domiciled at, but if that state conforms to the federal opportunity zone regulations, then they would actually be able to benefit on the state tax side. Each person would have to check specifically for their state where they live to see if it does. One sad thing, though, Alpesh, is that unfortunately California does not conform with it.
That's what I thought.
Yeah.
Poor California, right?
I know, poor California.
We don't make enough. We don't. We don't pay them enough taxes.
I know, right? Well, at least we still get a break on the federal side, though.
I see. No, federal is amazing. Can't complain.
Yeah, for sure.
So I think the benefits that there is no question about these benefits, but the problem is most of the investors or these wealthy individuals do not know about it or don't even know how to get started. And of course, I'm not an expert. I learned from you and some other friends about opportunity zones, right?
Yes.
Even for me to take advantage of it, it was pretty hard trying to find the property and figuring all this out. So do I have to purchase a property in the opportunity zone to take advantage of this, all these benefits, or are there other avenues?
That's a really good question. So there are different ways to participate inside of opportunity zones. One of the ways you can do it, you can physically buy property in opportunity zones, but you have to make sure that you follow the strict guidelines that are set by the Department of Treasury to be able to make sure it becomes tax advantage for you. I personally don't recommend doing it that way. What I would recommend for most investors out there is finding a really good qualified opportunity zone fund to invest in and just receive all the benefits without all the headache of trying to follow all the guidelines. So that would be my recommendation, is find a really good opportunity zone fund that has a good business plan and just invest that way.
So there are already opportunity zone specific funds out there?
Yes, there are. There's a few funds that are out there. Some are good, some are okay. There's a fund I work with that I like a lot. I think they offer a lot of great benefits. There's other funds out there that are not as advantageous based upon fee structure, things like that. And then also the biggest thing people need to worry about is, because this is going to get pretty big, and you got to make sure that whatever fund you go into, that the operators have experience in this, in real estate development, and they're buying at good locations, because getting a great tax advantage does not offset a bad investment.
That's true.
So I caution everybody who starts hearing about these to make sure that you're really looking at a good fund that has a track record and has a very solid management team.
That's the golden nugget right there.
Yeah.
So, and I remember you mentioned about a REIT as well. So is there a difference between a REIT and a fund?
Yeah. So there's some different advantages, specifically about this one REIT that I personally like, that they have some great advantages over a traditional real estate fund. So a traditional real estate fund typically charges higher carried interest fees and does not have the pass-through deductions of dividend income that a REIT has.
Oh,
So for example, carried interest typically in a lot of these real estate funds is about 20%.
oh
Where,
wow,
yeah, I know it's
significant.
yes, it is. And then also, they also don't have the care or the pass-through deduction for dividend income. So with this specific REIT that I like, they only charge 5% for carried interest. And since they're a REIT, REITs have a special provision where the pass-through deduction for dividend income is taxed at 20%. So that is great compared to a lot of other dividend income where it gets taxed at the long-term or the short-term capital gains or ordinary income tax rate.
Okay, that's interesting. So let's take a break, Stephen.
Yep.
Welcome back, everyone. We are chatting with Stephen about Opportunity Zone Fund and REITs. Hey, so and also, is there a difference between like a public REIT, listed, non-listed, and is the REIT we are talking about for Opportunity Zone, is that listed or non-listed REIT?
Yeah. So what's interesting is that this is the first public non-listed REIT out there for opportunity zones, and there are
Wow.
the first one. So these guys are very I think forward thinking, ahead of the curve. I think they have really thought through this quite well, and there are three main advantages for being a public non-listed REIT. The first one is that it's registered as a public company. And what that means is that it provides its shareholders and institutional reporting, transparency, and oversight without the volatility of the stock market. So really what that means for the investor is that there's more transparency in this investment because it is registered with the SEC.
I see.
The second one is the public company registration allows for non-credited investors to actually invest in this. So what that means is that investors are subject to a $10,000 minimum. So you have to come in with at least 10,000, but and then you just got to meet the qualified investor status. So this specific REIT has some qualifications you have to meet, but nothing major there compared to not other funds that are not publicly registered, where you have to be a qualified investor, meaning you have to make at least $250,000 or have $1 million worth of assets.
Yeah. So I was going there. So when you mentioned qualified, it's not similar to accredited investors, right?
Correct.
Where it's pretty strict.
Correct. Exactly. Yeah. You can literally invest into this REIT for as little as $10,000.
Oh, wow. So let me rephrase this. Pretty much everyone listening to this can invest in this REIT because 10 grand is nothing. It's a very small barrier because other investments I have seen requires 50 grand or even 100 grand as minimum. And second, you don't have to be accredited investors.
Exactly. So that's the second benefit. And then the third one for which I think is very big is that public registration gives the companies the ability to list their shares on the stock exchange, such as the New York Stock Exchange or NASDAQ. So the plan with this REIT is that in about 8 years they will go public, which then gives all the investors much easier ways to exit out of the investment if they want.
Yeah. So liquidity. Right?
Correct.
Yeah.
Correct.
Oh, that are some pretty interesting points, and I'm surprised that there is no other company out there doing this same thing. This REIT you are talking about is the first one.
Is the first one. Yeah, there's definitely going to be other ones that will follow, but I don't, pretty sure they won't have the all the great benefits that this REIT has with the low carried interest and their fee structures, so that would be able to compete with them. So that's why I'm excited about them.
And so this particular REIT you are talking about, how are the sponsors, or how are the the owners or the managers of the business? What's their track record, etc.?
Yeah. So the owners. Sorry, can you pause?
Oh yeah, sure. One sec. So can you talk about the track record of the owners or the managers of this REIT?
Yeah, so they have a pretty extensive track record. They specialize. What's interesting about this REIT is that they're going to be specializing in multifamily units. So their background is building brand new multifamily units from the ground up, and they'll usually have the first floor as commercial, and then the rest of the floors will be all apartment complexes.
Wow, I like multifamily.
Multi,
That's
I
what
love
I try
multifamily
to
too.
invest in, right? So this is even better.
Exactly. No, I love it as well. It generates cash flow, which is awesome, and it's something that everybody needs a place to live. So.
Exactly. Everyone needs a place to live, and it's more diversified because instead of one or two doors, you'll have 200, 400, 500 doors.
Exactly. Yes, and these guys have done multiple projects. They also have some of their top executives are from Avalon Bay. Used to be executives at Avalon Bay, which is one of the biggest apartment complexes or multifamily units in the country. So they have a very extensive management team with years and years of experience, specifically in multifamily. So that's why I really like what they're putting together here.
Oh, that's great. So, can you talk about returns and numbers, just at high level, just giving us an idea?
Yeah. So this specific REIT is going to be, ideally you want to be holding these investments for 10 years, right? Because that's where you get the real tax advantage.
That's when you get the maximum benefit out.
Correct. That's when you get the maximum benefit, and they're estimating that they're going to, investors should be seeing returns of about 12 to maybe 14% over a 10-year hold.
Okay.
And then, with the on the dividend side, once the properties are built and and it's spitting out cash flow from rents, you can be expecting anywhere from a 6 to 8% annual return.
Yeah, that's not bad. And if I hold it for 10 years, I don't have to pay any taxes.
Correct. Yeah. No, it's awesome.
So, I think we are at the end of the podcast. Did we forget to talk about anything in particular, Stephen, or I missed anything?
Let me see. I think one thing I'd say is that one of the things that we've not really touched on was when you sell any type of asset. So I think this is very, very unique. And then people who are familiar with the 1031 exchanges, they will understand why this is so unique. So usually when you're out there and you sell a property, and you want to roll it over to another property because you don't want to pay the tax, you do a 1031 on it. You have to roll over the entire cost basis and gain into that new investment. One of the great things about the opportunity zone is if you sell any asset, all you got to put into the opportunity zone is the gains. You can do whatever you want with the cost basis. You can go spend it on whatever you want. You just got to roll the gains into the opportunity zone and you delay the tax.
That's amazing again.
Yeah.
Because I was going to say this is 1031 on steroids, but it's not even on steroids. This is like 100 times better than 1031.
It's 100 times better, and people who have stocks that that have seen a great appreciation over this huge bull run we've had in the last 10 years, and they want to get out, but they don't want to pay all that capital gains. this is a great way that they can get out, take their cost basis, go buy something else, go do something else with it, and let their gains roll for another 8 years in a more solid, I believe, safe real estate investment vehicle, and receive a bunch of tax benefits for it.
Yeah. So, and just to remind my listeners that 1031 exchange allows you to exchange out of one real estate investment to another, and you can keep carrying that capital gain into the next investment. But there are lots of restrictions. One of the big restriction is you have to identify max 3 properties within 30 days of the sale of your investment property, and then you have to close on one of the 3 identified properties within 180 days, right? So there are lots of restrictions, but you have something like this where you can just invest just the gain, and you don't have to invest the entire cost basis. As well as you can go from stocks or any kind of capital gains into this. This is a no-brainer, at least for me.
Yeah, no, this is awesome. It's going to be it's going to get bigger and bigger. More people are starting to find out about it. One of the I think this is the best time to get in, because right now this is such a new opportunity that we don't know how the laws will change or adapt or morph into. But as of right now, the earlier you get in, the longer you can delay the taxes that were due on your capital gains, because as of right now, December 31st of 2026 is when your capital gains will be due. So if you get in this year compared to getting in 2 years from now, you're not delaying your capital gains as long. So that could change, but as of right now, the law is at December 31st, 2026. You got to pay your taxes on the original capital gains you put into the investment. So the earlier you get in, the longer that can be delayed.
Oh, this is awesome. So personally, I'm going to sign up, even though I don't have any capital gain right now, but this is a no-brainer just to hold it for diversifying, as well as just to get in 10 grand, nothing else, right? So
Yeah,
sign me up.
exactly. Now you know how to reach me. So
Yes, exactly. So if anything else in particular, Steven?
I think we covered a lot of the stuff that all the kind of high level important points for the opportunity zone. It's just I believe it's a great opportunity, and I think a lot of people are going to see it as well. So
Thank you so much, Steven. I really
thank you, Alpesh.
learned a lot today and appreciate you being here. Looking forward to chatting with you in next week or so about how I can get started with this REIT.
Likewise, look forward to it, and thanks again for having me on.
Thank you. Take care.
Thanks. Bye.